First, follow the purchase. The acquisition playbook, how they buy your last options. Okay, so here's how the purchase actually happens, step by step, without the sales gloss. First, they hunt. The target isn't the shiny park on the highway with new signage. It's the mom-and-pop property with paper books, handshake leases, undermarket rents, deferred maintenance, and a good location. In storage, it's the under-amenitized site with high occupancy and no revenue management. They build a pipeline, brokers, cold outreach data screens to surface owners nearing retirement, tired operators, or heirs who don't want to run the business. Next, they pre-underwrite the upside before making an offer. They model rent alignment to nearby comps, tack on utility billbacks, and layer administrative fees. They assume centralized collections will cut delinquency. They pencil in payroll savings by replacing on-site managers with a regional and a call center. In storage, they assume dynamic pricing, online move-ins, and auction cadence improvements. All of that goes into a pro forma that shows an instant lift to net operating income within 12 to 24 months. Now the financing. Most people miss this. They don't just pay cash. They use leverage marketed as affordable or essential infrastructure. For manufactured housing, they tap GSE programs under duty to serve or bank loans underwritten to the upgrade plan. The optics say preservation. The covenants say performance. Interest rate caps, DSCR triggers, and refinance timelines start the clock. In storage, it's often a mix of lifeco debt, CMBS, or credit lines tied to portfolio growth. Either way, the debt stack rewards quick NOI growth and punishes drift. When the seller bites, diligence looks like this: rent roll audits, meter reads, title and easements, environmental phase 1 capex scopes, and crucially, resident rules and enforcement history. They're not just checking risk, they're mapping the squeeze. Where can they implement submetering? How many homes are non-conforming? Which lots are underpaying? Where are the least organized tenants? They also price the political risk, local ordinances, notice requirements, right to purchase laws, and complaint channels, so they can stage changes in waves instead of all at once. Closing day is operational day zero. Control shifts to a template. Leases move to standardized forms with escalator clauses, fee schedules, and tighter default language. Month-to-month tenancies replace legacy long terms. For parks, water and sewer get submetered with an admin fee. Yard rules and parking enforcement sharpen. On-site managers become floating staff. Maintenance goes to tickets and SLAs. In storage, the online funnel opens. Move-in specials up front, automated renewal lifts after the promo burns off, and rate optimization, every 30 to 90 days based on occupancy and demand. Collections centralize. Autopay gets pushed. Late fee waterfalls become policy, not discretion. Eviction or lien processes are standardized, which means faster filings and fewer second chances. It's not personal, it's a workflow built to protect the model. Meanwhile, customer service shifts from a person you know to a portal that remembers nothing about your situation beyond the balance due. Capex starts where it moves rates. Not the sewer line you begged them to replace. The signage, the office refresh, the gate system, the cameras, the curb appeal, upgrades that support market repositioning. In storage, they add Bluetooth locks, better lighting, and insurance upsells. In parks, they pave the entrance, stripe the lots, paint common areas, and send a photo in the rent notice. The story is we're improving your community, which on a spreadsheet reads we've justified the increase. The legal layer is quiet but critical. They add riders allowing mid-cycle pass-throughs for taxes, insurance, and utilities. They include arbitration clauses and venue selection that favor them. They tighten home sale approvals and insist on exclusive broker agreements or park. Approval fees. Each clause monetizes motion. Every attempt to sell, move, or dispute becomes a revenue event or a friction point that dissuades resistance. Pricing becomes a system, not a guess. In parks, they set new move-ins higher and backfill legacy tenants over time with scheduled alignments. In storage, they run A/B tests on unit prices by size and floor, stair-step existing customers, and restrict discount stacking. The metric isn't fairness, it's revenue per occupied unit with churn thresholds. If the line holds, they push again. If churn spikes, they ease, then push later. The algorithm learns your tolerance. Portfolio strategy ties it together. The first park feeds the second acquisition with comps. The third justifies the refi. The fourth creates scale to negotiate cheaper vendors and higher valuations. Eventually, they pursue a roll-up exit, package 10 stabilized assets, sell to a larger fund or a REIT at a lower cap rate, and lock in gains. If debt markets open, they recap instead, pull out equity, restart the clock, and reset covenants that keep rent lifts on schedule. What about regulation? They manage it proactively. They log compliance, meet minimums, and charm with community days and newsletters. They show resilience plans and ESG metrics to lenders. When a state adds an opportunity to purchase requirement, they adjust timelines, fragment ownership across LLCs, or pre-negotiate. When a city caps rent increases, they fill the gap with fees outside the cap or faster turnover pricing. Game theory, not war. This isn't a villain monologue. It's a machine built from incentives. Find sticky demand. Buy with leverage. Replace humans with systems. Monetize friction. Iterate pricing. Refinance or flip. Rinse, roll up, repeat. Once you see the steps, you can start tripping the wires before the rider lands in your mailbox. The squeeze, engineering the survival tax. Here's where the model stops being theory and starts billing you. The first lever is the cleanest, rent lifts. They don't arrive as gouging. They arrive as alignment to market or stabilization. New move-ins get the highest number. Legacy tenants are placed on a glide path. 10% this cycle, 12% next, with a letter that says, "We're still below market." Once that anchor resets, everything else keys off it. Your neighbor sells? The buyer signs the new schedule, which becomes the next comp. The model rewards speed, normalize rates before outrage organizes. Then come utility billbacks. Water, sewer, trash, suddenly unbundled. You see submeter install charges and an admin fee to process your own usage. The pitch is conservation, the outcome is margin. When cities raise rates, pass-through clauses turbocharge the increase with a fee on top. In parks, that can mean a $60 swing that isn't capped as rent. In storage, insurance add-ons and protection plans show up as defaults. Decline them, and you'll see a waiver and a warning that your goods are at risk. Many click yes. The waterfall grows. Admin is a quiet goldmine. Application fees. Statement fees for a paper bill you didn't ask for. Convenience fees for paying online, the only way the portal lets you schedule autopay. Pet rent, parking stickers, gate fobs that cost $50 to replace, inspection charges after minor violations. Each is small enough to shrug off once. Together they outpace inflation. And because most rent caps don't touch fees, they function as a relief valve for the spreadsheet when the main lever is constrained. Algorithmic pricing turns that collection of levers into a discipline. In storage, it's overt, dynamic rates that flex by day, unit size, and building position. Occupancy at 93%? Push 7% on 5x10s, 3% on 10x20s. Hold climate control flat to backfill. In parks, the algorithm hides inside rent bands for new tenants and scheduled escalators for renewals. A/B tests run all year. If churn exceeds target, the system eases in one cohort and pushes in another, then re-aims the next quarter. You're not being singled out. You're part of a grid. That's why lawsuits and investigations into revenue management software are multiplying, because the grid may be coordinating what looks like a market. Contract terms do the compounding. Month-to-month storage with a teaser lets the owner lift rates every 30 to 90 days without triggering a renewal. Park leases move from annual to shorter terms or add automatic CPI escalators plus capital recovery riders. Miss one deadline and late fee waterfalls kick in. A flat fee day 4, a per diem starting day 6, a lien fee after day 10, lock cut fees if it crosses the line. Each layer accelerates from one mistake. The system isn't vengeful, it's calibrated. Maintenance becomes a lever, not a promise. In parks, they pave the entrance but defer the sewer line that backs up twice a year. In storage, they install cameras but delay roof repairs that drip on your couch. Why? Because curb appeal supports market, while invisible capex doesn't move revenue today. The irony is residents then pay again through capital improvement, pass-throughs when the long-deferred work finally happens, often at a premium rate baked into a multi-year schedule. Rule enforcement monetizes life. Yard standards enforced by drive-by photos lead to $100 fines. Extra vehicles draw towing threats unless you buy an additional parking pass. Home sale approvals tighten. Buyers must meet stricter criteria, pay an application fee, and accept the new rent. If your home's a little older, condition, gives the park leverage to deny the sale unless you upgrade, which you can't because the rent hikes erased your cushion. That's the trap. Rent up, equity down, exit blocked. Debt service math hardwires this cadence. Lenders don't ask if your town's factory closed. They care if the DSCR stays inside the box. If rates float higher or a cap expires, the gap must be filled by next quarter. Owners can't print savings out of insurance and taxes, so they print it out of you: rents, fees, occupancy. If a state adds a rent cap, the file pivots to fee schedules and turnover pricing. If a refi cliff looms, you'll see market alignment letters arrive like clockwork. Self-storage auctions illustrate the endgame. The notices feel bureaucratic, but the cadence is engineered: late, lean sale. The unit's contents go to bid not because someone wants your sofa, but because the threat disciplines the cohort. Perfect compliance is the point. In parks, economic eviction works the same without a sheriff. Rent lifts beyond your budget force a sale at a discount or abandonment. Either way, turnover is priced higher and the NOI ratchets. Tech removes mercy from the margins. Ticket systems triage your leak behind the rent call. Portals block partial payments that could stop the waterfall. Chatbots quote policy without discretion. Sensors flag violations that would have been a conversation with an on-site manager. Each automation closes a loophole where a human might have said, "I know you, I'll waive this once." The machine can't know you. It only knows targets. Here's the reveal: none of this requires illegal behavior. It requires inelastic demand, clever contracts, and time. That's the survival tax, extraction engineered through small, relentless increments that convert your lack of alternatives into somebody's quarterly beat. To counter it, you won't just argue fairness. You'll change math, terms, and timing with tools that already exist in law and lending. Next, the human bill: who gets hit, how quickly, and why the harms are predictable. The human cost, when affordable, becomes a trap. Let's put faces to this. Start with Ruth, 72, on a fixed income. Her lot rent was $465 when she moved in. After the sale, letters arrived like seasons: market alignment, utility pass-through, capital recovery. Within 24 months, she's at $605 plus $48 in admin and submetered water. Social Security nudged up 3%. The bill jumped 20%. She cancels the senior center, stretches prescriptions, and keeps the thermostat at 66. When she tries to sell, buyers walk because the new rent erases their savings. Every $100 increase wipes roughly $10,000 from her home's resale value. Her equity didn't vanish, it was priced out. Economic eviction rarely looks like a sheriff at the door. It looks like math you can't beat. The notice says, "We remain below market," but your budget says, "Not anymore." You don't get a formal eviction, you get forced decisions. Skip a payment, the late fee ladder clicks in. Fall behind, the park declines your sale until condition issues are resolved. You accept a lowball offer because staying another month costs more than you have. On paper, no one was evicted. In reality, you were extracted. Listen to Marco, a warehouse supervisor. He stores tools and his late mom's furniture in a 10 by 15. The move-in promo felt helpful. First month $1. Then life happens. His hours drop for 2 weeks. By month 4 the promo is burned off, rates standardize, and he misses the due date by 3 days. A $20 late fee lands, then a lien processing fee, then a lock cut fee if the balance lingers. He pays to stop the sale, but the waterfall took a chunk that should have covered groceries. The algorithm doesn't know grief, it only knows thresholds. Rules shape the grind. In Ruth's Park, new yard and parking rules arrived with crisp photos of violations. A neighbor's granddaughter parks overnight? Warning. 2 warnings? $100. The on-site manager who used to mediate retired. Now it's a ticket portal. In the same week, a community upgrade, email shows fresh paint at the entrance. The sewer line that backs up every winter? Scheduled for future evaluation. Upgrades aimed at appraisal help valuations. Repairs without curb appeal can wait. Surveillance replaces conversation. Cameras watch the gate. License plate capture ties fines to minutes, not stories. We saw your third vehicle at 1:14 a.m. Try explaining your caring for a sick relative. The chatbot quotes policy. The person who would have said, "I'll waive it once," is a rotating voice in another state. That's the efficiency illusion on the ground. Quicker enforcement, slower relief. Sellers meet a maze. Tenants line up buyers at fair prices, then learn about park approval. New buyers must pass application fees, background checks, higher credit thresholds, and accept the current rent band. If the home is older, condition gives the park room to deny. Paint the skirting, resurface the driveway, replace steps, all before closing, while every delay carries another month of the new rent. Deals die. Sellers drop the price. The park points to quality standards. The spreadsheet records reduced turnover time and higher release rates. Storage has its own spiral. A single missed payment spirals into an auction schedule. Notices arrive by email you rarely check because you work nights. You show up to pay, but the portal won't accept partials. The counter clerk shrugs. System won't let me. It's not cruelty, it's calibration. Allowing partials would break the waterfall. The company needs uniform discipline to run dynamic pricing at scale. The message is clear: be perfect or pay more. And when lean timelines are fast and fees stack, one mistake feels like a verdict. Seniors aren't the only ones caught. Families with kids absorb the shock through choices that scrape. One mom I spoke with downgraded to a smaller storage unit. She threw out half her kids' clothes to make it fit and cried in the parking lot because the locker was cheaper than late fees. Another family sold their second car to keep up with alignment, then paid more for rides when shifts didn't match the bus. The squeeze isn't spectacular. It's sandpaper against a budget until threads snap. Workplaces feel it too. People trade shifts to avoid shutoffs, pick up weekend gig runs to cover the protection plan, and arrive to Monday meetings brain-dead from stress. The survival layer leaks into productivity. Your boss won't hear, "My park added an admin fee," as a reason you're late, but that's what happened. Then health. Heat in summer, cold in winter, ration meds, cheap calories because rent, fees, and water ate the decent food. The doctor says, watch your sodium. The rent letter says, effective next cycle. You stop filling the good prescription, roll ibuprofen for back pain, and ignore the leak under the sink because maintenance requests feel like targets. You might think, why not organize? Some do. They form tenant committees, call legal aid, push for right-to-purchase laws, and sometimes buy their parks. But most are sprinting between bills. Organizing is a second job you do after your first 2 jobs. Owners know that. Speed beats outrage. Letters outrun meetings. This is the human bill. Fixed incomes stretched thin, families eating late fees, equity reversed by rent, rules weaponized by workflow, and lives bent around an automated cadence. It's not dramatic. It's relentless. And it's predictable because the incentives make it so. In a moment, I'll show the illusion that dresses this up as modernization and how tech becomes the mask for extraction. Then we'll get to the illusion. What actually changes the extraction? Okay, so here's the thing. What looks like modernization is often cost-cutting with a pretty dashboard. The pitch is seamless. Remote management, smart meters, portals, sensors, AI pricing. The promise is faster service and better transparency. But once you follow the cash, you'll see how efficiency mostly automates collection, enforces penalties, and normalizes permanent surge for essentials. Start with remote management. That on-site manager who could solve a problem in 5 minutes, replaced by a ticket system that routes through a regional hub. It feels orderly, case numbers, timestamps, service level targets. But those targets optimize queue time, not outcomes you need. A leak becomes Category B, 48 hours, even if it's under your cabinet today. Meanwhile, the collections queue enjoys Category A, same day. Efficiency is about what the system values. In this model, money flows faster than repairs. Sensors arrive next. Water submeters, gate cameras, plate readers, occupancy counters. The brochure calls them sustainability and safety. In practice, they're enforcement engines. The meter doesn't reduce your bill, it itemizes it with an admin fee. The gate camera doesn't deter crime. It auto-flags your cousin's car for an overnight violation. The data improves one thing above all: precision in charging for behavior that used to be handled by conversation. Dynamic pricing is the crown jewel. In self-storage, operators run airline-style yield. Occupancy at 92%. Nudge 5x 10s this week. Test 10x 15s next. AI'll be the promo. Burn it off. Reset. In manufactured housing, it's quieter. Rent bans for new move-ins, escalators for renewals, and alignment letters scheduled across cohorts. Nobody admits a robot sets your rent, but the outcome is algorithmic. The tool is indifferent by design. It doesn't ask who got sick. It asks whether the revenue curve hit target. That's why transparency and caps on algorithmic pricing of essentials are becoming live policy debates. Now, this is important because tech lets owners claim neutrality. It's the system, as if policy didn't encode the system. Portals block partial payments because partials disrupt fee waterfalls. Chatbots repeat policy to avoid waivers. Autodials trigger at hour 25, not day 3, because acceleration improves collectability. None of this is illegal. It's intentional. The machine eliminates discretion because discretion is expensive and inconsistent. ESG becomes the moral wrapper. Decks highlight LED retrofits, low-flow fixtures, paperless notices, and community engagement. Those are fine things, but ask who pays and who saves. If a lighting upgrade lowers operating costs, do residents see a bill credit, or does the resilience fee fund the fixture while the savings expand margin? If a submeter curbs waste, is the admin charge removed once costs drop? Or does the fee remain as a forever line item because the model learned it could? There's also the compliance theater. Clean dashboards for regulators, response times, inspection logs, call resolution stats. Meanwhile, residents wait for the non-visual capex that actually prevents the next backup. Cameras go up quickly. Sewer lines wait for the next rate cycle. We're modernizing is easy to announce at the gate. Replacing the clay tile under lot 27 is expensive and invisible. Everything changes when the financing stack meets the tech stack. Lenders want predictability. Tech provides it. Centralized billing, instant delinquency reporting, and automated legal notices show discipline. That discipline earns better terms. Better terms reward more discipline. It's a loop. The more the system governs your life, the more bankable the asset becomes. Efficiency, in that sense, is primarily a capital story disguised as a service story. Here's a micro moment. A tenant tries to dispute a $100 yard condition fine. The portal offers two options: pay or open a low-priority ticket. The ticket SLA is 5 business days. The fine compounds after 3. She pays to stop the clock. The system registers a successful collection event and strengthens the case for expanding fines elsewhere. Efficiency measures the speed of cash, not the fairness of cause. Meanwhile, smart insurance add-ons show up in storage checkout flows as pre-checked boxes. You can decline, but a warning screen implies you're reckless. Some operators earn commissions on those plans. Bundle that with auto rate increases, and you've shifted a consumer essential into a subscription-style product with multiple growth levers, none of which require improving the unit you rent. You might be thinking, does tech ever help residents? Yes, when it shortens real fixes, enables transparent ballots for resident votes, or routes emergency work faster than before. But that requires aligning incentives. KPIs for resolved problems, not tickets closed, credits for failures, not apologies, open APIs that let watchdogs see. Pricing patterns, not black boxes labeled proprietary. So how do you read the signals? 3 tells. 1. Automation appears first in collections and enforcement, not maintenance. 2. New fees where process labels, portal, statement, convenience, without corresponding cost declines elsewhere. 3. Climate or resilience language justifies rate-based expansion while the savings don't flow back. When you see those, you're looking at extraction wrapped in efficiency. The fix isn't to reject tech. It's to demand tech with guardrails. Require partial payment options that halt late fee ladders. Mandate that submeter admin fees sunset once install costs are recovered. Tie algorithmic rent changes to transparent caps and publish methodology. Force automatic bill credits for missed SLAs. And make pricing data auditable to detect coordinated patterns. Because once you strip the buzzwords, the question is simple. Does the system make it easier to live or easier to bill? If the answer keeps landing on billing, you're not looking at modernization. You're looking at the mask. The debt engine, why prices must go up. Now we get to the part nobody advertises. The math that makes raising your bill the safest choice on the owner's side of the table. Once leverage funds the purchase, every quarter becomes a scoreboard. Debt isn't background noise. It's the metronome that sets rent cadence, fee timing, and alignment letters. Start with the buy. A leveraged acquisition stacks senior debt, maybe mezz, sometimes an interest rate cap, all under covenants that measure performance in 2 simple ratios: debt service coverage, DSCR, and loan to value, LTV. DSCR says, Your net operating income must be at least X times your debt payments. If NOI dips, because occupancy softens, insurance spikes, or taxes jump, the ratio tightens. Owners can't cut debt service on demand, so they raise the knob they control, price. Floating rate loans add a second twist. When rates rise, monthly payments reset higher. Caps blunt the worst spikes, but caps expire and hedges cost money. As the coupon climbs, last year's comfortable DSCR turns into this year's breach risk. Lenders don't care that a plant closed in your town. They care that coverage is 1.25x, not 1.18x. That 7 basis point gap becomes the urgent 8% rent lift you saw in January. Refinancing cliffs hardwire deadlines. A 5-year term with an extension option sounds flexible until valuation multiples compress or cap rates expand. If you can't refinance on equal or better terms, you must show a stronger NOI to keep the loan size. How do you show it quickly? Price, fees, and churn management this quarter. Not after the election. Not when wages recover. Now, CMBS and securitized structures add automation to the pressure. Pooling mortgages into bonds creates servicing rules and triggers. Miss a DSCR threshold or debt yield target, and you enter a watch list with mandated remedies. Tighter budgets, cash sweeps, faster enforcement. You won't read those in a welcome packet. You'll feel them as zero-tolerance late fees and policy, answers where mercy used to live. Here's why fee stacking survives rent caps. Covenants test NOI, not rent line items specifically. If a jurisdiction caps the main lever, owners move recovery into categories outside the cap: utility billbacks, admin, insurance pass-throughs, processing. The document the lender accepts is an income statement. If total income rises and expenses pass through, the test passes. Your city's ordinance didn't fail. It just didn't touch the metric the loan monitors. Manager incentives align to the same North Star. Asset managers are paid for AUM growth and NOI beats, not resident tenure. Portfolio lenders award cheaper money for properties with consistent revenue discipline. That discipline shows up as fast collections, few concessions, and predictable escalators. People call it professionalism. In practice, it's debt compatibility. Uniform rules that make the cash flow bankable. Insurance and climate risk torque the engine further. Premiums spike after a storm. Lenders require coverage. Owners pay, then pass through, then add a resilience fee labeled prudence. If state law slows reimbursement, the DSCR still ticks today. The gap gets filled where it always does, by someone who can't move their house or their grandmother's dresser. Debt doesn't hate residents, it's just indifferent to their timelines. That's why fee sunsets and project scopes matter. Resilience shouldn't turn into a forever tax. Interest-only periods are another tell. Many acquisitions start with 2 or 3 years of IO to juice early returns and fund upgrades. When amortization kicks in, the debt service jump can be 15 to 25%. Unless operating costs fell, they didn't. Something has to rise. A portfolio manager will call it normalization. Your budget calls it surrender. Securitization also turns fee streams into bond-like comfort. Late fees, admin charges, and insurance add-ons are stable, small, and numerous. Aggregated, they smooth total income across seasons, which improves modeled default probability. Granular cash flow is a selling point in investor decks. It's also the argument for keeping waterfalls rigid. Partial payments jam the gears that make fees predictable. You might ask, what if owners cut expenses? They do on people. On-site managers become floaters. Maintenance goes periodic. Work orders hit SLAs, not outcomes. Those cuts show up fast in margin and please the covenant. They also degrade service until a capital event forces catch-up. Then a capital recovery surcharge arrives to repay the fix that deferral made bigger. Everything changes when cap rates move. If market yields rise, valuations fall unless NOI grows. To refinance at the same proceeds, you must show more income on the same dirt. Rents become arithmetic, not opinion. Even good guy owners drift toward the same answer because their lender, their equity committee, and their exit math all point one direction: lift. Finally, portfolio scale amplifies the treadmill. Cross-collateralized loans tie assets together. A weak park drags the strong one's cushion. Rate shocks in Florida prompt alignment letters in Ohio. Consolidation was supposed to deliver efficiencies. It did, and it also synchronized the squeeze across zip codes. So when you ask why your bill rose again, The honest answer is because the loan said so. The debt engine doesn't care about fairness. It cares about cadence. To beat it, you have to change the inputs, terms, timing, and ownership, so the only lever isn't your wallet. That's next. The flashpoints, where this model fails.